to the I Love Annuities Podcast. I'm Jeremiah Conger.
And I'm Zach Van Ness, and together we are the
Annuity Dudes. And together we're taking a little bit of a different approach here. We're bringing you a kind of hybrid series where we're combining our I Love Annuities podcast and combining it with our sister podcast, which is called the Annuity Researchers Series. And so with those two combined, we're taking a deep dive into real annuity products from across the independent annuity marketplace.
That's right. Today we're doing something a little different. We're literally going page by page through the newest EquiTrust Bridge brochure so that you can better understand, number one, how that product works, two, who it's designed for, the mechanics, the pros, the trade-offs, and where it may fit into your retirement planning.
Yeah, before we delve into that, Zach, I just want to ask, man, how have you been since the last recording of the I Love Annuities podcast?
Well, it's been a minute, but been good. We've been busy, had a lot of moving parts with the company, so happy to get back to it.
Absolutely. Yeah, I couldn't be more excited to be here. Continue, building value around, really taking deeper dives into these products, taking a more comparative analysis approach to help people ultimately gather the information they need to make a more informed, empowered, and confident decision on, A, if an annuity is right for them, but B, if it is, which one of the hundreds of annuity products out there is truly the best fit. And that's really the sole intent of our podcast. It's the sole intent of our company. It's the mission that we are on, and that's to help people make better annuity buying decisions. And we do that through trust and transparency and education, of course. So let's go ahead and delve in here. So, this isn't investment advice. This is educational analysis designed to help consumers become more informed buyers instead of being sold blindly, which is essentially how this industry has been built, is based on an antiquated sales model that, really just focused on selling versus educating. And that's where we're taking a different spin on it. That's where we're really trying to turn this antiquated industry upside down and really make it more consumer friendly and ultimately more empowering to consumers to make a more informed decision because they have the knowledge and they have the data that they need to really make a good decision. So let's go ahead and jump in here.
Yeah, let's do it. I'll get this pulled up on the screen. We'll take a look at the brochure for the EquiTrust Bridge. That way you can see it firsthand. If you happen to be driving and not able to see it, no worries. We'll go through this so that you can better understand it through audio as well. All right. Boom! There we go.
Nice. All right. So right out of the gate on page 1, the product positioning is actually very clear here. The tagline says, long-term care benefits when you need them, retirement savings growth when you don't. And honestly, Zach, that's probably one of the better summaries of what this product is truly trying to accomplish here.
That's right. And looking at this, I mean, couldn't agree more. This is essentially trying to solve two problems simultaneously, right? So the long-term care risk and asset preservation and growth. When we look at long-term care, as we've spoken with many clients before, that long-term care component is many times a thorn in the side when we bring that conversation to light. And that's really what makes this product fundamentally different, is it's just not your standard long-term care insurance.
Yeah, I think this is one of the most under-discussed risks that we all face in retirement. The statistics today show that if you're over the age of 60 and a married couple, there's a 70% chance that at least one of you will have a need of some form of long-term care in the future. And, after speaking to thousands of clients over the years, one of the common, gaps that we see in someone's overall plan is that they don't have a formal plan or true plan to address long-term care. They've done a really good job saving. They've done a good job planning for income. That's obviously why they come and speak with us primarily, is for income, guaranteed income. They've done a great job planning for sequence of returns risk and volatility risk and a lot of different risks, but one that they tend to overlook is this long-term care aspect. Actually, a gentleman I just worked with recently, man, this guy's done an incredible job saving. You know, he was never really a true high-income earner, but he was a really good saver. And he's amassed, a few $1,000,000, and he doesn't have any children. He's not married. Really doesn't even have any next of kin that, could really help him in any way. And he came to us looking at an annuity because he has an older annuity that's about to fulfill its contract, and he was looking for something else to roll that money into via a 1035 exchange. And by taking him through the entire process and trying to truly understand all of his goals and all of his current plans that he has in place, one of the things that I identified was he didn't have anything set up for long-term care. And so I asked him, I said, what is the goal for this money that you currently have in this annuity? And it was it was like $235,000. And he's like, really didn't have any true intended purpose for it. He just said, well, I just want to grow it and not have any risk on it. And I asked him, I said, well, have you ever thought about repositioning this into a long-term care annuity? And when he heard that, he didn't even know that those types of products existed. And then the other thing is that he said, I've never really even looked at long-term care because my current financial advisor told me that I don't have to worry about that I can just self-fund it when and if that time comes. And whenever I hear there's a financial advisor who holds a fiduciary responsibility, and their answer to addressing long-term care is that you can just self-fund it when you need to, I just completely roll my eyes, because that is not being a fiduciary. That's not, just because he could self-fund it doesn't mean that that's the best approach. Mm-hmm. And the reason that I say that is because obviously as you age and as you start to get older, your cognitive abilities start to decline. And if you don't have a true plan in place for long-term care and something happens and you're not able to make the same decisions or don't have the capacity for decision making as soundly as it once was, and you have all this cash, you have all this boatload of money, right? You're very vulnerable in that state, and you're going to probably be taken advantage of. And so self-funding is never the answer. Planning is the answer. And why not? Even if you have a good amount of money and you don't have any legacy goals or whatever it might be, wouldn't it still make sense to have a plan in place that could leverage contractual guarantees to make your dollars go further? But more importantly, so that there's a concrete plan in place that then can be part of a trust and part of a will that governs what parts of the plan go to what necessities, and having that piece of the puzzle covered really affords someone peace of mind. But more importantly, it allows you to have more clarity that you're not going to be as vulnerable and taken advantage of. If you do have family that's close to you, they're not going to feel as much of a burden trying to manage your assets and figure out how much money of your self-funding should go towards long-term care and what happens to the rest. It really helps everybody keep the ducks in a row so that everybody is taken care of at the same time of a difficult time that they're now starting to trek down together.
Yeah, and I think we've even seen just an example that I've run recently that I'm working on a case with. A little can go a long way, especially in a tool like this. And we'll go through some of the details, but I think we'll find there's a lot of value, again, with a little bit that we can put into this.
Absolutely. So we're looking at page 2 now, right, Zach?
Yeah, we're going there now.
So page 2 is going to explain the core structure of what this product is. What is the EquiTrust Bridge? Well, first and foremost, it's a fixed indexed annuity. For those that may not be 100% familiar with a fixed indexed annuity, a fixed indexed annuity is a protected growth vehicle that's going to contractually guarantee your principal. It's going to have the ability to earn interest on a non-guaranteed basis according to the underlying market-linked index strategies that you're allocated to. And in the event of a downturn or a negative performance from any of the associated indexes, your money stays whole. You can't lose anything to market downside risk. And then when you factor those aspects combined with that this product has a long-term care rider, it really makes it a shield when it comes to protecting your assets, but also planning for long-term care. It does both at the same time. And then last but not least, it does have another benefit, which is called the NeverStop Health Coaching and Rewards Program, which we'll touch on here in a brief bit.
Yeah, this is really important because when consumers often hear a hybrid annuity, may not fully understand what that means. And when we're looking at this, just to simplify it, break it down a little bit, at its core, we have a fixed index annuity. So safe market growth with the ability to pass something on. And in addition to that, you've got this long-term care rider, right? So we were bolting on, if you will, a component that adds value to this. Now, it's important to know that with a policy like this, it does require non-qualified funds. And in correlation to that, it's a tax-free benefit. So if that long-term care component is used, that's all tax-free money. In addition to that, we have this wellness component, which can add additional benefit to that policy. So it is a true hybrid. It's using multiple facets of the annuity itself to provide value in multiple areas.
Absolutely. So on the FIA side, the fixed indexed annuity side, it's going to provide, like Zach said, tax-deferred growth potential, principal protection from market losses, and accumulation value. And that long-term care rider is what's creating the leverage towards those qualified care expenses. And that's the key word there, leverage. For every dollar that you put in, it's going to create this long-term care benefit pool that's contractually guaranteed. It's not tied to the markets. It's not tied to any uncontrollable. It's truly contractually driven, which puts the power in your hands, puts the power in your plan, and allows you to be better prepared when and if that time comes that, hey, you've got this pool of benefit that you can, really stretch and make it go far. And the key here is that you're leveraging the insurance company. And every dollar that goes in is going to have a multiplier of some sort to build that benefit pool quicker, more efficiently, and more importantly, more guaranteed than anything else out there. And finally, we talked about this wellness program. It's designed overall to help improve health outcomes while potentially increasing long-term care benefits over time.
That's right. That third component, the NeverStop Health Coaching and Rewards Program, is really what differentiates this product from almost everything else in the marketplace. When we look at this, keep in mind there are not a ton of these long-term care annuity products on the market, let alone that have this component built into it.
Yeah, so let's really, delve into what makes this different from traditional long-term care insurance. So moving to page 3 there, Zach, gets us into one of the biggest talking points, and that's how this differs from traditional long-term care insurance. And this is where I think consumers really need to pay attention here.
Yeah, so when we look at this, traditional long-term care insurance usually means a couple of things: ongoing premiums, stricter underwriting, and often a use it or lose it mentality that comes behind it. Now, this product instead uses a single premium structure. So very different, very much more so driven along the annuity component.
Yeah, and most importantly, they specifically state that everyone is approved. I mean, think about this. Everyone is approved. It's just what level of approval or what class are you approved at? So now, obviously, you still have to satisfy annuity suitability requirements, which is pretty simple to do. But from a long-term care perspective, this is dramatically easier underwriting than traditional long-term care insurance. So it's really ideal, right, for people that may have had previous health ailments or diagnoses, if that's the word, for serious health complications like heart disease or cancer or even Alzheimer's or dementia. These are ailments that would naturally and normally knock you out or disqualify you from traditional long-term care insurance. And so with this plan, it's a little simpler in terms of the medical underwriting. It's more of a question-based knockout format versus actually having to go through a full-on health exam with fluids and blood work and all of those other things. So let's go ahead and delve into some of that. Zach, take it away, man.
Yeah, so in addition, they also cite that approximately 70% of people turning 65 will require some form of long-term care. So a huge statistic and why we find value in a product like this, because many people assume, hey, that won't happen to me, but statistically, there's a good chance that it might. And when we look at this and the capability, the point that you drive home here is the medical component or the examination component, right? So at the end of the day, if you can get onto a Zoom meeting with us, you can do the underwriting that it requires for the qualification for this product. It is a Zoom meeting that's 20 to 30 minutes. You have that meeting with Assure Allies, and from there, we get the determination same day. So pretty simple process, nothing elaborate to your point, no blood work or anything that comes with it.
Yeah, and this is a product, too, that I think is ideal for someone that maybe just overlooked the importance of long-term care, and as they've gotten a little older and they realize, hey, I'm still pretty healthy, and my mother or father lived a long life, and maybe they experienced long-term care, and, as this scenario is unfolding right before their eyes where they're starting to age, but they still feel good, they realize that they're maybe too old for traditional long-term care insurance because the premiums would just be exorbitant. Mm-hmm. And this is an ideal solution for someone that is planning late in the game for long-term care. Maybe you have some money sitting on the sidelines, just randomly, from old 401ks or IRAs or, even bank CDs or whatever. It has to be non-qualified money, so that's important to note here. But anything that you would have in savings that's just needing to be repurposed, this is an ideal product and solution for filling the gap of that long-term care need. Yep. Let's go to page 4 here, Zach, and start looking at the long-term care rider mechanics. So this is where the mechanics really start getting important. Page 4 here is going to explain the true mechanics of this long-term care rider. The long-term care benefit amount is based on your long-term care benefit base. And that benefit base is calculated by your initial premium investment multiplied by the coverage ratio, which is based upon the class that you're approved for.
That's right. So when you look at this, a big piece to understand here is that the care benefit can last for up to 60 months, so up to 5 years. And at the same time, while it's growing, it will grow. The care component will grow at a guaranteed rate and increase at 3% annually for up to 20 years. So question around inflation and how that may affect somebody now versus 10 years or 20 years from today. Important to know that this is also providing an increase in that benefit guaranteed at 3% annually. And critical to understand because this benefit base account, what's calculated for that long-term care is not the same as the actual accumulation value. So the cash you put in is different calculation from that long-term care benefit. And it really exists for the function in the calculation of that long-term care payout.
Yeah, now the easiest way to understand the mechanics of what's occurring inside of a policy like this, and it's really no different than a fixed indexed annuity with a lifetime income rider. This product has a long-term care rider, but the mechanics are exactly the same. So if you really picture, and if you're sitting at home taking notes, draw out a capital T for a T chart. And when you buy a policy like this, you're going to essentially have two values that are tracked and monitored independently of one another. So this long-term care rider is creating that right-hand side column of the T-chart, which we'll call your long-term care benefit pool. And then the left-hand side of that T-chart, that's what we would call your account value or your accumulation value. They're completely independent. The main point here is that the right-hand side, which is the long-term care benefit pool, that is contractually driven in terms of how it grows, day one from the policy issuance, and then how it grows over time during deferral as you continue to age and get closer to risks like long-term care. The left-hand side, that accumulation or account value, that's your real money. That's the initial premium investment that has the ability to earn interest on either a guaranteed or non-guaranteed basis. There's a fixed account that's offered in this product that your money can be allocated to that can earn, I think right now it's like as high as 4 or 5%, if I'm not mistaken there, Zach.
Yeah, 5%. Yep.
So it has a 5% guaranteed fixed rate that your accumulation value can grow. And in addition to that, it has these indexing components, such as the S&P 500, where you can participate in the growth of the S&P 500 each year, but you're also protected from downside risk. In the event the S&P doesn't have a good year and it's negative, your money stays exactly where it is. It doesn't experience any losses incurred from that negative performance. The main point of this account value, which is the left-hand side of that T-chart, is that it's your death benefit. So when we talk about if you don't use it, you don't lose it, that account value on the left-hand side would pass on to your designated beneficiaries in the contract should you never use this product for long-term care. Maybe you die of natural causes, never needed specialized care or long-term care. That account value that's been growing all this while will fully pass to your heirs or designated beneficiaries with no fees or penalties. And that's really the beauty of this product is, you're utilizing it for long-term care planning, but if you don't use it for that, it still has had its fair chance to earn interest over that long period of time that can build this legacy benefit that can then be passed. I have a client too an existing client bought an annuity, a couple annuities a few years back, and I just had a review with him. And I brought this product up to his attention because he doesn't have anything for long-term care. And this gentleman's a conservative investor, doesn't like to take a lot of risk, has a good amount of money saved, got his income annuities a few years ago from us. And right now I asked him, I said, what are you doing for your investment side of your portfolio, the growth side? And he's like, I'm just buying bonds, man. He's like, I'm getting 4.34%. I'm happy with that. It's above inflation. I don't have to lose sleep at night. And I said, his name's Tim. I said, Tim, there's a product right now that you could get 5% in the fixed bucket. There's no ups or downs. There's just a pure 5% compounded interest rate, which is above what you're getting in the bonds. And you could kill two birds with one stone by, this long-term care benefit pool growing at a guaranteed clip. And he loved the idea of that. I mean, it was a no-brainer. And we're going to put one in place for him and his wife here soon. Just to repurpose some money he's already investing, getting a conservative rate of return. He can do that in this product, but also know that he's got a plan for long-term care that he didn't have before.
Yeah, and listen, you're also not handcuffed. When I say that, what I mean is you're not forced into only using this for long-term care or a death benefit. In addition, you've got 10% access to make withdrawals annually, right? So if life throws a curveball, you didn't plan to take out withdrawals from this, you have the option to. Now, it will proportionately affect the long-term care component, but at the same time, this isn't just a one-answer solution. So I think the value comes in the flexibility with a product like this, and I can't be happier that we're actually reviewing it. So pumped.
Agreed. Exactly right, man. And so let's talk about this coverage ratio real quick on the long-term care benefit pool. That's going to range anywhere from 100%, which is 1-to-1. Every dollar you put in as a premium counts in as the long-term care benefit pool. But there is a max available sometimes upwards of 300% based on age and the underwriting class. And the rule of thumb here is that the higher the coverage ratio, the larger the long-term care benefit pool is going to be. But generally, that may mean that there's going to be a lower preserved accumulation value in exchange for that higher long-term care pool.
Yeah, absolutely. Let's see here. So we've got these updates covered. That's covered. I think we nailed down page 4, so we'll jump to page 5 here.
Well, there's one point there to cover real quick I don't want to skip over, is this long-term care pool, after it receives its multiplier, which is based again on your age and the underwriting class, this long-term care benefit base also grows at a guaranteed 3% annually for up to 20 years. So that's important because the older version of this product and others on the market were as low as 2%. So this product has been revised and improved to really address inflation and ensure that that benefit pool is growing at a minimum of 3%. But remember, you're getting that multiplier that's added in day one. If you're getting a 300% multiplier on this long-term care benefit pool, if you put $100,000 in, day one, your long-term care pool is $300,000 starting out of the gate, and then that's going to grow at 3% every year for up to a max of 20 years.
Right.
So let's go to page 5, right?
Yeah, page 5 gives you a good illustration of exactly what you were mentioning there. So when we look at the coverage ratio based on the qualifier, whether that's standard or preferred, you'll notice that these adjustments can happen, and that's a good example that we'll see here at the top of page 5. So this page, really one of the most important educational pages in the brochure, and if you can understand the information here, you'll understand the product the most. So the chart on page 5 visually shows that trade-off between the long-term care leverage and the accumulation value. So what we're looking at here, the accumulation value in this blue color, the cash value, and we can see in this green color, the long-term care benefit base and how that coverage ratio exceeds the actual accumulation value.
Yeah, so let's explain this actual payout structure. The brochure here states that monthly long-term care benefits reduce the accumulation value dollar for dollar, but benefits continue even if the accumulation value is depleted until the benefit base reaches zero. And that's a really huge distinction, and that's what really sort of creates the value and the power of this product, is that contractually, even if your account value or accumulation value has been depleted over time, the benefit base is still going to produce those dollars for that long-term care coverage.
Oh, exactly right. Another major feature, the benefits that you're seeing here, these are indemnity based. So a big component to consider when we're looking at this is that this could be care provided by a loved one, could be care provided by nursing home or health aid, assisted living. At the end of the day, long story short, no receipts are required. So granted, we need a physician's certification, that there's a qualification for this, but at the end of the day, indemnity benefit, a big value that comes with a policy like this.
Yeah, and I think that that's ultimately one of the biggest value adds of the product like this, is that, when you look at some of the older traditional long-term care insurance plans, they did require receipts. They required record keeping, and more importantly, that which was the least beneficial to the policy owner, was a lot of times these long-term care insurance providers paid the benefit directly to the facility. And so you never got any money in your own hands. And I don't like that aspect of it, because it's almost like the facility has all the control and they have all the power to charge and rack up the bill, if you will. Not saying that they do that, but it could possibly become a scenario that is a true event. But with this, the funds are paid directly to you. And so that keeps the power and the bargaining chips, if you will, on your side of the table, so that you know exactly where those dollars are going. and you know how to disperse them, and you have the power to disperse them at your own discretion. And really, the other aspect is the flexibility aspect that also provides. You can pay your family caregivers. So even if you don't have a nurse or something that's coming to your home, but you have someone in your family that can still provide care, you can compensate them accordingly. You can also use this money for the specialized nurse or nursing care that's in your home. So it's in-home care, not nursing home care. They're coming to you, and you can use this policy to fund in-home care services. In addition, if you need to modify your home, if you need a wheelchair or a hospital bed or railings to help you get in and out of your shower, or railings for your getting into your house. Sometimes there's like ramps that they build custom so that you can wheelchair up to your house, and there's a ramp or railings associated with that. You can make the modifications you need to make your home more accommodating to your current, lifestyle or living. I don't know the word there, but to really accommodate your health situation at that point in time. And last but not least, if you do need assisted living facility services, obviously this can be, really a tool to help you get into an ALF, an assisted living facility.
Yeah. Yeah, and I think a key component that we need to really consider here is that there is a vesting schedule that comes with this, right? So for the first 4 years, 20%, 40, 60, and 80, and then finally in the 5th year, you're 100% vested into using this long-term care component. And this does apply specifically to the net amount at risk, the net amount at risk being that long-term care. So, and that information that you've got there, keep in mind that this is likely not ideal for somebody who's thinking, I'm probably going to use this claim immediately or in the very near future.
Yeah, so you got to make sure that you're in good health, at least to get through that 4-year vesting period. Obviously, none of us have a crystal ball to know what's going to happen, but it is sound planning to know that, hey, I don't need it right now or in the near future, but I'm going to need it possibly at some point after 4 years. That's when it really makes sense. So moving to page 6, we're qualifying for benefits and underwriting. This is really going to discuss how someone does qualify for these long-term care benefits. Essentially, the individual must either be unable to perform 2 out of the 6 activities of daily living. So this is things like eating, feeding yourself, getting up and out of bed, toileting, walking, talking, so on and so forth. So those are the 6 activities of daily living. If you're unable to perform 2 out of those 6, then you would qualify for long-term care benefits. The other way to qualify is that you require a substantial supervision due to cognitive impairment. So if you have dementia, Alzheimer's, or any other ailment that is impeding your cognitive abilities, then you would obviously qualify as long as there's a requirement for substantial supervision due to that issue. So it's pretty standard long-term care qualification language overall.
Yeah, and it does mention caregiver strain. So we mentioned the flexibility that we can have a loved one care for us in a capacity of using this annuity. So this is one of the biggest overlooked issues in retirement planning. Really, family caregiving, keep in mind, this can become emotionally and financially devastating. So ultimately, can it be done? Absolutely. But we've also got to consider what may happen with that and how that can affect the family.
I can't even tell you how many times I've talked to people, prospects or clients that we have, who have told me those types of stories about how they had to take care of their parents, or something happened where there was a disagreement amongst the family members about how mom or dad would be taken care of, and it does rip families apart. And I actually experienced that in my life. Not going to talk too much about it, but just to give you some insight on my story, my grandfather had a stroke when he was in his mid-60s, and it completely paralyzed him on the left side of his body. And my mother, she has 2 sisters. They all agreed initially to take care of him and, to kind of help out equally, but for one reason or another, life got in the way sometimes when it was the other person's responsibility to start caring for him. And it created like an issue, right, within my family dynamic, because sometimes the care felt like it was being put on someone's shoulders more than the rest, financially, emotionally, psychologically, etc. And so, long story short, my mother and her sisters agreed to put my grandfather into a specialized care facility. And that kind of took the blow off of, some of that stress. But still, I mean, even then, like, it was still a very stressful time. So not having anything formal and plans for this, really sets you up for that type of, potential disaster or stress. But having a plan in place, having at least the financial aspects covered, just takes so much pressure off of the entire family. So yeah. Let's go ahead and delve into the underwriting portion of this, Zach. So if I'm not mistaken, this process is handled through a company who is an affiliate called Assured Allies. Is that right, Zach?
That's right. So when you look at that, Assured Allies is going to do this all online. Like I mentioned, just as familiar as we are with using Zoom for our client meetings, that's really what this is. So there's no medical recordings needed, no medical records needed, 30-minute video interview. And in my communication with clients, I say, hey, listen, I'm happy to be a part of it if you want, but I don't need to be. So I would suggest do it on your own. That way there's no pressure from me that may come from that. And really, it's a series of questions, stand up, sit down, they're checking mobility, things like that. And really, going back to what we had talked about already, at the end of the day, no matter what the outcome of that meeting, everyone is approved in some underwriting class.
Yeah, and I think that's probably the strongest value proposition of the entire product, especially for older retirees or people that are late in the planning game for long-term care, or people with current or potential future health concerns, or those who've already been denied traditional long-term care insurance, is that they can go into this product and the application process knowing without a doubt that they're going to be approved. It just comes down to what level or what underwriting class are you approved at.
That's exactly
so let's
right.
go into page 7 real quick, Zach. I know you've got a couple minutes and then you got to run. But the NeverStop Wellness Program. So when we get into this, it's probably the most innovative piece of this product, the NeverStop Health Coaching and Rewards Program.
Yeah, so this is essentially a wellness and aging support platform built into the annuity. And participation may actually increase the long-term care benefits through wellness credits.
Yeah, so when we look at the program, it's going to include things like coaching, wellness planning, accountability, and science-based healthy aging strategies.
Yeah, and really it's important philosophically because most products only address specifics, right? So what happens after you get sick? This product is also trying to address how do we help people stay healthier longer? So it's not a post response. We're trying to prolong and keep somebody healthy with this NeverStop Wellness Program.
Now, the key thing to understand here is that there is a $100 annual fee tied to this program. It's $100. It's not the end of the world, but it is important for consumers to know that there is a $100 annual fee tied to this benefit.
Yeah. Yep.
So moving over to pages 8 and 9, Zach, are we good on time or you got to run here?
Yeah, we're good. You're good.
Okay. So page 8 and 9 shift into the actual annuity mechanics. We kind of touched on it earlier with our T-chart exercise, but we'll get into some more specifics here. This is where the accumulation side of the product comes into play.
Yeah, so the product offers, again, this is a fixed index annuity at its core. So the product offers fixed account options, current rate on that fixed account is 5%. You can see it here, the index options that we have. This is inclusive of the S&P strategies, and there's more than one S&P strategy. We've talked about this before, but you've got an S&P cap strategy and an S&P participation rate strategy. Now, some questions may come up. Hey, it's great that you have these options within the annuity, along with a Barclays Focus 50 and S&P Mark 5, which is a volatility controlled strategy. But important to know that these are no lackluster index options. When we look at the S&P performance or the S&P cap and participation rate, the cap is 9%. Go out on the market and look at a fixed index annuity that's available today without this long-term care chassis and tell me what the highest is that's out there. Jeremiah, off the top of your head, what's the highest that you know of out there?
I mean, recently it was a tad higher at one point, but
yeah,
it's going to be within the range that this one's offering for sure.
This is one of, when looking at this, 9%, I've seen 10 and 11%, don't get me wrong, but this is on the higher end when we consider this has multiple facets that come with it.
Yeah, absolutely. I mean, it's definitely a product that makes a lot of sense, right? It's like, even if you're just in the market for a regular indexed annuity for protected growth, why wouldn't you just go in with this one? Like, you killing two birds with one stone. And I think that's what you're trying to say, Zach, is that you're not actually giving up a lot to get the benefit, the added benefits that this is bringing to the table. In terms of like the S&P 500
right.
cap rate at 9%, man, that's an incredible offer. In addition, the participation rate's at 50%. So every year in an annual point-to-point strategy, whatever the S&P 500 does, you're going to participate in 50% of it. So if it goes up 20%, your contract's credited 10%. So that's a really, really good value, especially for the conservative or moderately conservative investor that doesn't want to take unnecessary risk at this stage in the game. They're just looking for an easy, simple index to follow and track and participate in without taking any unnecessary risk to get a fair rate of return. You take that opportunity right there that this annuity provides and then bolt on that it can give you up to a 300% multiplier for long-term care if you qualify. I mean, it's incredible, man.
Without a doubt. Without a doubt.
So the most important thing here is that, again, it's a principal protected, contractually guaranteed product, but while allowing for upside potential through those index crediting. Let's move on to page 10, Zach.
Yeah, so page 10 gets into liquidity, right? So like I had mentioned earlier, the contract does allow for a 10% free withdrawal every year after the first year. So keep that in mind. We don't have access to that 10% free withdrawal in the first year, but after that we do. You've got option for account transfers and flexible premium allocation, meaning that you can actually apply or add additional funds to this for the term of owning it.
Yeah, and consumers really need to pay attention here that this is a 10-year surrender schedule product. So this is not short-term money. This is something that requires you to keep the money in there for 10 years. If you do cancel or surrender, which is the technical term for that, within the 10 years, there would be a surrender penalty that would be assessed. After 10 years, you could access all of your accumulation value with zero penalties and cash out if you wish, and move on and do something else with it with no penalties whatsoever.
Exactly right. Let's see here. We know we've also got the listed surrender penalty information. That's all shown here on the brochure. And by the way, if you want more information on this, just reach out to us. We're happy to provide anything that you're looking for. Page 11 does jump into some additional riders and protections that come with this policy. And with that, it's discussing those protections, which are inclusive of minimum guaranteed contract value that's baked into this, nursing home waiver, terminal illness rider, death benefit, and a free look period as well.
Yeah, I do like the nursing home waiver feature. That's something that I'm fond of because, someone is confined for 90 consecutive days or more in a nursing home facility. the surrender charges may be waived, right? So if you're within the 10-year period of time for the surrender schedule, you have to go into a nursing home and you're just like, hey, you know what? I'm better off taking the full accumulation value versus the long-term care benefit value in terms of the actual monthly benefit. Then you have the right to do that. You could cash out or surrender the account or accumulation value and access all of those proceeds with no surrender charges.
Exactly. And another thing that I like about this, the death benefit is straightforward, right? So the remaining accumulation value just passes to the beneficiaries without a surrender charge. Again, we go back to it being an annuity at its core. As with many annuities, the same thing. Not a complex process for the death benefit being passed on.
Yeah, another thing that's often under discussed is that annuities are recognized by most states as no different than a will or trust. So oftentimes, when the annuitant passes, the death benefit proceeds go on to the designated beneficiaries and often avoid probate and the cost normally associated with that. So that's another thing to note, is that annuities are recognized similar to a will or trust in that they avoid probate in most cases.
Yeah, exactly.
So,
right.
Zach, what are your final thoughts here, man? This is a pretty amazing product that we have that's come to the market. I think it addresses a lot of the pain points, a lot of the gaps within people's plans, and I think it's a really great value. What are your thoughts on this?
Yeah, I mean, ultimately, it's innovative, right? So when we talk about this being a hybrid long-term care annuity, we've seen a few out here recently. I'm sure we'll touch on the others that are out there, but especially because this one, the EquiTrust Bridge, addresses the guaranteed issue access, wellness, and accumulation preservation. So looking at, it applies multiple facets that I'm looking for in a fixed index annuity, again, along with bolting on that long-term care. It's a strong option for anybody looking or who are not approved for long-term care on their own. The conversations that I've had with folks whose long-term care policies have increased over time gradually or pretty steep in the most recent time, it's crazy what some of these long-term care policies have become. So just a great alternative with that annuity at its core.
Yeah, I agree. And, just to be clear, this is not a max guaranteed income annuity, nor a pure growth focused annuity. It's truly a hybrid. And that's what I think is unique and, like you said, innovative, is that it's really still giving you the ability to grow your money safely, have those contractual guarantees around principal protection from market downside risk, but simultaneously giving you the ability to plan for long-term care cost in the future and building up a pool of benefits that's guaranteed and not driven by anything other than the contract. And I think that's really the biggest differentiator, is that it's putting the power and control in your hands and not, the markets and all of the other normal uncontrollable ways of kind of building or accumulating our wealth. It's also ideal for those conservative investors that are just out there chasing the highest CD rates and chasing the highest fixed rate annuities and, keeping their money in a money market account that's barely pacing inflation. And I talked to someone the other day, they're a veteran, retired federal cop. They're keeping their money in the G fund in the TSP, which is like barely pacing inflation. Like, these dollars could be put into this vehicle, those dollars could be put into this vehicle and earn a much higher rate of return, even in the fixed account at 5%. But if you want to put some allocation towards the S&P, if you go back to just 2 years ago, the S&P was up like around 24%. If you're in the 50% participation rate strategy, you would have earned 12% on your money that year, while also building this long-term care pool that's guaranteed. So it's a really nice product for those that have, dry powder on the sidelines, looking to do something with it, looking to give it a bit more leverage. Again, that's the key word. This is a product that should be in your scope and one that you should be checking out. And we're happy to show you this product and also compare it against the other competitive products that are in this space. This isn't the only one, and we're going to be doing some reviews on the others, but I really like what this one has to offer.
Yeah, in looking at it, really, it's designed for someone who says, hey, listen, I'm worried about long-term care, but I also don't want to throw my money away, right? I still want this money to be whole, and if I don't use it, I want to pass it on to my loved ones. It's not lost. It's still yours.
That's right. And for someone who may not qualify elsewhere, they want flexibility, they value indemnity-style payouts, and they want some retained accumulation value over time. This could absolutely fill an important planning gap.
Yeah, without a doubt. So listen, if you'd like help comparing this product against traditional long-term care insurance, other hybrid annuities, like I mentioned, there are a few others out there that are really competitive, just like this one, just different components to it. Or if you're also considering self-funding strategies, we'd be happy to help educate you on the annuity options that are out there. So no pressure, no product pitches, as we've always said, and we always will, just transparent comparison and education.
Yeah, with the intent to lift your annuity IQ and help you feel more confident about how you're viewing the marketplace. You know, we're an independent annuity advisory firm. We specialize in helping people make better annuity buying decisions. We do that through transparency and education, and we use a comparative analysis-based software that ranks these products side by side, and will teach you the exact framework on how to compare these annuities, how to understand all the features and benefits, and really kind of lift the hood and look what's underneath to ensure that you're going the right direction, that you're looking at the right products that align with your goals and objectives. And in doing that, you know, we really hope that we can earn your business through the trust that we're instilling in us, but as much as we are in yourself, to make a better decision around such an important thing, like, you know, taking a good piece of your nest egg and putting it into a product that can address long-term care in the future. We're honored for that opportunity to meet with you. We do that through Zoom. We work with clients in all 50 states, and there will be a link here in the show notes to book a meeting with myself or Zach or one of our other members, and we'll take you down that path of understanding, help you bridge the gap and lift your annuity IQ, and help you ascertain the marketplace in a more simpler, easier manner so that you can confidently select which annuity is right for your situation. Obviously, we'll sprinkle in our 2 cents there and affirm if you're looking at things the right way. And that's the goal, right? As we work at this as a team, we come together. There's no pressure, no sales tactics, nothing of the sort. It's truly an informative and educational process. And we're confident that we can help you and put you in a better position. And if you do business with us, we're thankful and grateful from the bottom of our hearts. If you don't, and it's maybe not the right fit, we shake hands and part ways as friends, and we move on. So we appreciate your time. Thank you for tuning in to another episode of the I Love Annuities Podcast / Annuity Researchers Podcast, since this is a hybrid episode. And we'll see you on the next one. Go ahead and sign us out there, Zach.
We are the Annuity Dudes.